Hey everyone, and welcome to this explainer. Today, we're putting on our financial detective hats. We're going to tackle a concept that honestly catches even the most seasoned investors off guard. I'm talking about the illusion of reported profits. Because, sometimes what you see on a financial statement, well, it's really just a surface-level story that absolutely begs for a deeper investigation.
Here's a harsh reality of the business world. Profit on paper isn't always cash in the bank. You could literally have millions in reported net income, yet completely struggle to keep the lights on, simply because the actual money hasn't arrived yet. And that's the central mystery we're going to solve today.
Okay, let's dive into this. When you're staring at an incredible profit figure at the end of a quarter, the very first question you need to train your brain to ask is, are those earnings actually real? That single question leads us right to the core concept of our explainer, earnings quality.
To get us there, we've got a really clear roadmap. We'll start with the profit illusion, then define earnings quality, look at the accrual accounting gap, compare high versus low quality models, show you how to spot financial red flags, and wrap up with becoming a smart investor. All right, let's go.
Section 1. The Profit Illusion.
So earnings are definitely not all created equal. They generally break down into three distinct slices. Your operating earnings, that's the core engine of the business from day-to-day activities. This is your highest quality slice because, frankly, it's reliable. Then you've got non-operating earnings, things like investment gains, which are a lower quality. And finally, one-time or non-recurring earnings. Think of selling a piece of land. That is the lowest quality because it's essentially an illusion of growth. I mean, you can't just sell the same piece of land again next year, right?
Moving on to Section 2. Defining earnings quality.
Formally speaking, earnings quality is the degree to which reported income reflects the true economic performance of a company. But let's put that into plain English. It simply means, how much can you actually trust the reported profits? If those numbers accurately reflect the real, cash-generating reality of the business, well then your quality is high.
Now, what's really interesting about this slide is the stark contrast between these two models. High-quality earnings, they're like a brick fortress. They're sustainable, rooted in core operations, backed by strong cash flow, and completely free from manipulation. On the flip side, low-quality earnings are essentially a house of cards. They're temporary, they're volatile, heavily influenced by creative accounting choices, driven by non-operating activities, and crucially, they just aren't backed by real cash.
Which brings us to Section 3, the accrual accounting gap. Under accrual accounting, a company records revenue when it's earned regardless of when the cash actually hits the account, and they record expenses when they're incurred, not when they're actually paid out. This creates a massive and sometimes totally dangerous gap between net income on paper and the actual cash reality in the bank. And guess what? This exact gap is where literally all earnings quality issues are born.
To navigate this gap, you need a decoder ring. And here it is. Earnings equals cash flow plus accruals. Now, don't just look at this as boring math. It's actually a super powerful lens. It tells us that any reported profit is simply a mix of hard cash and accounting adjustments.
Let's break that equation down a bit more. Cash flow is the real, tangible money generated. Accruals, on the other hand, are non-cash adjustments. Think of it like money promised but not yet paid, and these rely heavily on management's judgment. Because accruals are subjective, higher accruals immediately mean lower earnings quality. If you're studying for the CFA exams, lock this concept into your brain right now. The relationship between high accruals and low earnings quality is tested heavily.
Let's move to Section 4, high versus low quality models. Let's see how all of this builds into a real-world business comparison. We've got two companies here, Company X and Company Y. On paper, their net income is identical, 200 crore rupees. If you only look at the bottom line, they look like absolute twins. But look closely at the operating cash flow. Company X generated 180 crore rupees in actual physical cash. Meanwhile, Company Y only generated 50 crore. Company Y's key trait here is high receivables. That means they're logging all these sales, sure, but their customers aren't actually paying them yet. Huge difference.
So the crucial point is exactly why Company X wins this matchup. Their profits are backed by real, tangible cash. They rely significantly less on accounting accruals, which means they're not leaning on management's subjective judgment. Ultimately, Company X demonstrates really high earnings quality. Company Y's identical 200 crore profit, it's just a low-quality illusion that's practically waiting to collapse.
All right, Section 5. Spotting financial red flags.
Let's get into your advanced warning signs. If you see revenue growing way faster than cash flow, that is a massive red flag. Increasing receivables, like those unpaid bills we just saw with Company Y, is another big one. You've also got to watch out for frequent changes in accounting policies or profits that are suspiciously propped up by big other income contributions. And definitely be skeptical of sudden, unexplained margin improvements, or when management starts capitalizing expenses. That basically means they're hiding a daily running cost by recording it as a long-term asset. No good.
So why do these red flags pop up in the first place? It's usually because of a few major drivers of manipulation. Management might aggressively recognize revenue early just to artificially inflate their current profit. Or they might delay recognizing expenses. They could even use highly favorable accounting estimates for things like depreciation or bad debts. And while all of these tactics absolutely boost today's numbers, they do it at the severe, inevitable cost of tomorrow's profits.
Finally, Section 6, Becoming a Smart Investor.
And this brilliantly illustrates why ignoring earnings quality has such massive financial stakes. By focusing on it, you can actually predict future earnings a whole lot more accurately. It dramatically reduces your risk of falling victim to financial misstatements, and it improves your overall valuation accuracy, meaning you actually pay what a company is worth. But most importantly, it protects you from the devastating losses that happen when overvalued, low-quality stocks suddenly crash the moment the cash runs out.
Now, for those of you specifically tackling financial statement analysis in the CFA Level 1 exam, here are your actionable pro tips straight from the source material. Number 1, do not ignore the cash flow statement. Focus on it just as heavily as the income statement. Number 2, constantly practice comparing net income to operating cash flow. 3, learn these real-world manipulation techniques because I promise you they will appear in tricky exam questions. 4, utilize ratio analysis like cash flow from operations divided by net income. And above all else, never ever trust profit blindly. Always verify the quality.
Which brings us to our final thought for today. Whenever you look at a company's financial success, I want you to ask yourself, are you just reading the story they want to tell you, or are you actually uncovering the truth? Earnings definitely tell a story, but as we've seen today, they don't always tell the truth. By mastering earnings quality, you strip away that accounting illusion. Keep questioning the numbers, and you'll be a much smarter, safer investor. Thanks so much for joining me on this explainer, and I'll catch you in the next one.